Yeah, without a doubt, I'm sure that as the IPO frenzy increases, advisors get asked questions about, hey, can we participate? Hey, I hear Uber's going to IPO. Can we get it? Can we be a part of that? So talking through how it makes sense to be a fiduciary in that regard is a topic we're going to be touching on today as well. All right, well, let's jump right in. And Raj, maybe we'll start with some context and why this topic is worth covering now.
Well, we've seen a huge tech bounce back, led the way down last Q4 of 2018. And I remember I was talking to a few advisors at a conference, and they were saying, my clients ghosted me. They just kind of bowled out from their custodian and didn't even look back. Funny enough, that kind of bad behavior is likely panic selling, and so a lot of what Hidden Lever's value proposition sometimes on the downside is avoiding that. We've had an amazing tech bounce back, leading the way, and so a lot of that might have been profit taking. We don't know, but now at the other end of that, IPOs are, just a spate of IPOs is coming this spring and summer, and so all of that amidst with a few duds already, including Lyft. And so the kind of microeconomics picture, the fundamentals picture of each of these IPOs needs to be studied, whether by the asset manager you're doing it through or by your economic research team. But all of that is in the backdrop of the surprise upside GDP numbers, right? All these, especially sharing economy, that's the handshake on the right, all that sharing economy stuff that millennials love and other generations of Americans and people worldwide are kind of moving to, just cultural shift now that gets its day in the sun in the public markets. But again, all of that in a surprisingly upside economic numbers. And so we'll talk about whether that's for real.
Absolutely. And one of the things with the tech bounce back in this chart you have in the lower right, Raj, is that as you mentioned, of course, January of last year, we were roughly at these levels. I believe we touched maybe 8,000 on the NASDAQ for the first time. We got just a hair higher in October, but in the context of a lot more volatility because we had, some gyrations, through 2018. And so now we're back here again. And let's talk about what, if anything, is different. So we'll certainly cover the economic context in more detail. All right, well, to start, let's jump into hidden levers for a moment. And one of the things that we could look at here in looking at hidden levers is, first, if I just go over to our scenario library, I just wanted to point out really quick, 2019 IPOs is the name of the scenario there, very clear with that IPO calendar image. And so you can drill into the scenario right here. We will be loading, as always, you'll find today's presentation deck. Since this is a brand new scenario, we don't see it yet here, but right in this lower left part of the screen is where the presentation slides will be available when we're done today. So that's one piece that we're going to be dropping in place. Another thing I wanted to call to your attention within the tool is, and we're going to be talking about this more, but this sort of very winner-take-all nature of technology, and I'll just touch on it for a moment. You'll see in the classification of some of the technology stocks, we've chosen, and at Hidden Levers, we do diverge from the standard S&P GICS classification of both stocks, and also funds at times. So we've created a tech giant industry category. I just wanted to make you aware of that. Of course, Apple, without a doubt, would be part of the, any industry category called tech giants. And really the way that I look at this, I think the way that we look at it is that what are those companies that are really the winners of this winner-take-all technology sector and economy, and who is that group, and how are they different, from, let's say, there are a lot of companies that were almost there, the Intels, the Oracles of the world, maybe Salesforce. There's certainly quite a few companies that are large tech players, but they're not the true tech giants. These are the giants that are shaping the future, that have literally billions and billions and billions of dollars to invest in artificial intelligence and all sorts of forward technologies. So we'll talk about that category. And so I wanted to point that out to you. This is a custom industry classification. It doesn't exist outside of Hidden Levers, not in this way. But we choose to do this because we don't think that the traditional labels apply to companies like, Apple and Google and others that we'll talk about today. And so,
if there's a trend, they will own it. You know, you look at what Microsoft is today. It is a cloud computing company. You know, 20 years ago it wasn't. It was a software company only. You know, discs in the mail. Apple Computer. 10 years ago, it started on its journey of being a handheld mobile sets company. Now it is very much transitioning into a software as a service company. You know, subscription software. Recurring revenue thing. So they will own the future, and so that kind of nature of a tech staple as opposed to a kind of a separate sector, you know, that's where we're headed with tech giants. So if you don't have that much time today, we just want to give you a few takeaways. You know, it's all summarized by that by the two hands collecting all the poker chips. You know, first of all, it is a gamble. We're seeing the market at large, not just VC, not just private equity shops, not just hedge funds, investing in very unprofitable companies and rewarding growth, right? That is what the nature of these IPOs are. They're going for the Amazon type gamble, like let's own a category, let's destroy everything else around us, and let's go for growth. And we know the market rewards that as opposed to profitability. In terms of that winner take all, that has been the pattern of success for the tech category IPOs. That does take some time, and so in such a case, you know, if you're a fiduciary out there, if you're an asset manager type listening, you know, go for your gut, I guess. But for the fiduciaries in the audience, the RIA folks that have a best interest duty, you know, the idea would be spread your bets in this fantasy league or within a category. Pick the category. Those are discernible by easy economics, you know, kind of Peter Lynch type thinking, and then within that, spread your bets either through funds or the different IPOs coming out. So, you know, maybe is that a 50-50 bet on Uber and Lyft? I'm not exactly sure, but you know, having both would be a better idea, and then having the winner play out half a decade from now, you know, wouldn't be bad. In terms of a major thing to talk about, it's the fact that the spate of IPOs, you know, when there are this many coming up at the top, usually that's indicative of top of cycle, you know, people getting out and getting their equity dollars, their hard investments from the early days, getting that out before it's too late. And so we've had several occasions, including the year 2000, that was the most prolific one, where tons of companies going public before the belt tightening or before a recession comes. And so, you know, banner years are followed by bad years for the market. So that's what usually happens.
Yes, you know, we'll talk about, you know, some concrete numbers in terms of correlations there. The one more note I thought that's very interesting about the very top bullet point on this slide, Raj, this idea that that growth is valued over everything else, you know, in terms of technology companies today. And we certainly see that it's true, and we'll talk more about that. But really what I think is happening, if we think about it from a high level, is that, and this is, you know, you talk about how fiduciaries should spread their bets. If we think for a moment about the way VC firms work, we'll understand why. Because in essence, companies that previously might have figured out a profitable business model by the time they got to IPO, now are figuring that out after they IPO. So in some sense, everybody is being asked to play VC. So you're putting your VC hat on, and so you ask yourself, okay, well, how does a VC run their business? Well, they tend to invest in 20 or 40 or 50 or 100 companies, and they basically are perfectly fine. Let's say if they have a basket of 20, they are perfectly 100% fine with 19 out of 20 going bankrupt. And that, in fact, is kind of the way that they push their companies. They push them very hard. What we talk about, you know, from our perspective as entrepreneurs, what we talk about is the idea that they try to run 20 companies at a wall at 90 miles an hour. One of them will break through, 19 will crash into the wall and die. And that's okay by them, because the one that breaks through will be worth more than all the rest combined. And so, but this sort of investing philosophy, precisely why it's very risky for end investors. And historically, this wasn't the way the IPO market worked, but it does appear to be the way the IPO market is working increasingly. And so if you're being asked to be a VC, well, then do like them and, you know, spread those bets.
Well said, Praveen. All right, so let's talk about, you know, small breakdown. I'm sure you're bombarded by content about the IPO calendar, but just a quick look for completeness sake, and to talk about growth over profitability as the mode of operation.
Yeah, so if we look at this here, I mean, the calendar, it's not a precise calendar. This is 2019. A couple of these companies have already gone IPO, as you mentioned, Raj. Beyond Meat was today, down at the bottom there, and so that reflects actual valuation as of today. Levi's went out earlier in the year, and of course Lyft did as well. But the balance of these, and these are big companies. Of course, Uber is the giant in the bunch, but many of these names are well known. Almost everybody's heard of Airbnb by now. WeWork, certainly a lot of folks who are looking for office space in a lot of major metros around the U.S. and want to work in a co-working type environment. And increasingly, I think large companies are actually working with WeWork to have small satellite offices all over the place. So more and more folks are exposed to that. So many of these, of course, as you mentioned before, are household names. It's a big calendar this year. We'll touch on the exact numbers, but at Right, I thought this was really interesting, and this sort of helps to capture this idea. This is 2018. Well, it's kind of profitable versus unprofitable at IPO. The fact that growth is the most important thing is really what we're highlighting here. And you can see that over the course of the past year, for like 2017, 2018, you see that blue line, companies who are profitable at IPO, relatively speaking, have been punished versus companies which were unprofitable at IPO. So growth stories are the ones that are being rewarded right now. So that's sort of concrete metrics just around actual price change. Maybe historically, going back a number of years, it was more of a mixed picture back and forth, but very recently, at least, the growth story has taken hold. And of course, those of you that are value investors might roll your eyes and say, okay, that's just a short-term trend. And it may be so, but we're just noting what the IPO market is asking for and what investors seem to, based on their actual behavior, be willing to accept. They're willing to accept unprofitability or lack of profitability in pursuit of growth.
So that, what we need to do, Praveen, is find that for the late 90s coming into the tech crash, see if that same divergence happened then where, profitability was kind of shunned.
Yeah, well, I mean, as we know, in the tech space in the late 90s, although I absolutely agree with you, it'd be great to see across all IPOs. This chart does kind of highlight it a little bit, right? So we can see here the share of U.S. IPOs without profitability at debut. So going back to the early 90s, and we can see that at the height of the dot-com bubble is when we had roughly, it was almost 90% of all tech companies that were IPOing were not profitable at IPO. And the gray line there is all IPOs. So it does include tech companies, but it's other sectors as well. So you can see that peak that it hit, and and then it falls off and it falls off. But here we are again. We're back to those dot-com level eras, or that dot-com level era, or the com era level, where roughly 85% of IPOs are loss-making. They're without profitability on the day they go public. So we can see even from the last couple of years that a lot of companies are content to stay in that mode for sometimes years, multiple years, even 3 to 5 years. And even whenever they stop losing money, Amazon is, of course, the big story that's known for this, but Amazon always reinvested every last dime that was coming in the door. And so they never show any profits. And, that has powered their growth story. So that's really, if anything, that's the example that IPO happy investors are looking for. What's the super growth story that we can hitch ourselves to? What's the next Amazon, so to speak? But yeah, Raj, this really speaks to what you're talking about, right? The fact that everybody was unprofitable in 99, and then here we are back there today. Yeah. Now, why is everyone doing that? That's really interesting.
It kind of the arc there in the mid 90s, that slope. And if you go back a slide, it's the same.
Absolutely. Right there, that sort of shooting upward kind of effect, unprofitable at IPO.
Yeah, it gives me pause.
Well, this previous slide is just showing how investors apparently love unprofitable companies even after they IPO, because this is post-IPO, money-losing IPO companies, they are doing well in the public market. Whereas companies that are profitable at IPO, maybe those are from other industries, but they're shunned. And so, well, if that's the way the market's going to treat you, then of course that's the way companies are going to respond and behave. Another note, I mean, this applies even to the tech mega caps. So Google, as many of you will know, reported earlier in the week, and their stock was punished right after earnings were released because although their profits exceeded expectations, their revenue did not. So the top line growth wasn't what investors were looking for. And even though they beat on earnings, that's not enough, not for a growth story. And so they went down, roughly 10% in the final days or in the next day's trading.
It's super draconian considering they reported record earnings.
Right, exactly. And so that's very much the outlook that the market seems to have for these growth companies. They want you to take over the world first and then worry about profits. Once you sort of monopolize your category, then that next worry comes. Now, if we want to ask the question, okay, why are investors behaving this way? Is this rational? Then the right-hand part of the slide really focuses in on that and what investors are looking for. The idea being that these top 5 companies, they dominate U.S. technology and really global technology to no small extent. So we've got 3 companies in Apple, Microsoft, and Amazon that are, all of them, I believe, have spent a turn of a couple of days at least, at a $1 trillion valuation, or maybe part of a day in market cycles with over $1 trillion valuation. And Google's not far behind, and then you have Facebook more like around 550 billion. But look at the gap between them and then the next largest company. And so here we see tech companies, but if I were to throw ExxonMobil, which is historically one of the largest companies by market cap in the U.S., it's in at 300 and change, so it's well below Facebook. All of the largest companies in the United States today, by market cap, they are all technology companies. And, it's gotten to the point where there's simply no comparison because Facebook is not that far from being double the size in valuation terms of ExxonMobil. Apple at the top is triple the size of ExxonMobil. So, those are, really staggering numbers when you think about the actual amount of real physical capital involved in ExxonMobil's business versus many of these tech companies. And it just shows what's being rewarded. The stat at the bottom right makes that clear, even sort of within the NASDAQ, which is more tech-oriented. Out of a $10 trillion total market cap of the entirety of the NASDAQ, 5 companies are responsible for 40%. So that's very much a winner-take-all kind of a statistic. And then just to zero in on an example, for Google, I almost don't even have an example for you of like how much more are they worth than their competitors, because it's hard to even name viable competitors within the search space now. But Facebook is worth more than 12 times the combined valuation of Twitter and Snap. So Snapchat and Twitter might be the 2 other viable, independent public social media companies. And together they're worth around 45 billion. So again, Facebook is just absolutely dominating that space. And that's true across the board for each of these.
Okay.
And Raj, I think.
Well, the ideas you touch on there is, this concept of the FAANGs that gets constantly thrown around as people invest in tech and keep it as a separate category as part of their investments. Is that even worth having anymore? We discussed that in December, in the dark days of 2018. That was the last war room for 2018, where we covered the tech bubble. And one of the outcomes was, have we reached peak FAANGs? The kind of downside outcome. At that time, you had Facebook tanking due to a regulatory smackdown and its own ills. Since then, they've recovered quite interestingly, which tells you that regulatory smackdowns are temporary in the end. And we've also had a big bounce back from Apple, from them. They're kind of changing over to a new paradigm for what they consider the driver of their business. But that, with all those micro economic talks about their business, those are great for CNBC. Praveen and I and the team here at Hidden Levers, we're much more macro thinking. So when we think about things, it's about these technology companies that have largely taken over the economy, right? And so it's not just ExxonMobil that is a big company that's taken over or that's kind of outstripped by the market caps of these companies. It's more just the economy in general. And so this concept of the tech giant or the tech staple, the same way you have big consumer staples like P&G, etc. These big names come to stay, and so they're in an odd place. The Google's only rewarded for growth, whereas if maybe it was in a different category besides tech, it might have been rewarded for profitability. But nonetheless, we really want to be careful in terms of staying away from that FAANGs concept, because the leadership at the top now is increasingly narrow, right, and unforgiving, and so that MAGA term has nothing to do with the administration, but it's over the past 12 months we think it's gotten a lot of traction, and these are kind of household names here to stay, and whatever growth comes, it may not be organically, it may be through acquisition. We know for sure Google and Apple, they're acquisitive. Even Facebook, the best things it's done has been its acquisitions, to its credit, right? Between WhatsApp and Instagram, I think it's creating a lot more value for its shareholders or market cap than it is from its own ad revenue, which is definitely it's not on the up and up. You see Netflix there at the bottom highlighted. That just doesn't belong in the category. Yeah, it's a great tech investment, but it's not again a tech staple. And so carving that out here is what we want to do. You can see there the Google 10% hit that Praveen was talking about. The idea there is that even the MAGA names, those big tech names, the tech giants, they're rewarded more for revenue growth than they are for profitability, which is unlike other staple big of that caliber. Nothing's really of that caliber, but so it's kind of funny to see that where the IPOs of today and these kind of legendary tech companies, that's where that common thread is still there. Mature companies are more rewarded for profitability and kind of after an EBITDA, really EBITDA creation. But here even though these companies are gigantic, it's still about growth.
Right. Actually, one thing that I think is interesting about it, and just looking at this list and looking at the market cap numbers, Google, if we for a moment kind of put Humpty Dumpty back together again and give them their 10% back, all four of the top four companies are very similar in total market cap. Obviously, they're not exactly the same, but they're in the same category. And then you have Facebook kind of as a bit of a laggard, if you were to call it a group of five. But really, if we ask the question, again, why are investors so fixated on growth with this bunch? To a certain extent, there's that open question of who can win the future. And that's who can win the artificial intelligence battle of the future, who can invent the next sort of big things in a, as Mark Andreessen, the famous venture capitalist, says, he talks about software eating the world. So whose software will eat the world? Is that back to Microsoft? They've been ascendant. Actually, as we see, they've added more market cap than anybody on the list over the past 12 months. And, so they're ascendant again. Is it going to be them, or is it going to be Apple as they expand beyond their traditional hardware? Or is it going to be Google coming from the search angle, or Amazon, which is sort of like the octopus with an arm virtually in everything and constantly expanding? So really, I think that's what it is. And that's why it's the race to see, can one of these be the overall winner? And in particular, in an environment where U.S. antitrust law doesn't actually have doesn't really have any tools for this, right? Because it's not like there's no argument that Google is overcharging you for their search because it's free, and similarly with Facebook, it's hard to make price arguments about issues. There may be other issues, but issues that aren't traditionally covered by the law. And so this is sort of new area. And so for now, at least, they are continuing to get bigger and get more powerful. And that's why they're being rewarded for that growth.
If you look at that last column there on the right, you know, how much GDP, how much market cap these companies have added in the last 4 quarters. I mean, that's where the FAANGs term really falls apart. You know, we really, although some of the same pairings are there, and maybe there was some fetishization of tech investing. Really now it's these top four: Microsoft, Apple, Google, Amazon. They are or will be just Dow components. They will be the industrial drivers. Whatever we consider the Dow 30, this will be the four companies that do that. And as you can see there, just the amount of market cap they're adding in the last 12 months is probably outpacing most of the Dow in general. Definitely the GEs of the world. But there too with Facebook and Netflix.
Actually, that's an interesting question. If you were to exclude these four companies from the Dow and just sum this last column, so that comes to about 600 billion in gross additions, over 600 billion, that might be equal to the entire rest of the Dow. Not far off it if you were to subtract these, you know, because some of them are Dow components themselves. It's kind of funny, but yeah, it shows the scale of it. Well, Raj, you know, we were talking about this idea about how advisors and how fiduciaries should handle, you know, tech investing and considerations of when your clients bring up IPOs. So what's the right way to think about this, and, you know, think about how to think about these new categories?
Well, Praveen, you know, we're getting lauded a lot lately in the press about kind of having fiduciary as top of mind, keeping RIAs in mind as they carry about their business, as opposed to, you know, kind of helping them be tempted against flouting that fiduciary duty, kind of leaning into that. And that's kind of what makes us different, you know, telling serious truths on economic events, upside and downside. No investment products to sell you. No real, you know, we do have some asset managers as customers, but none of them are here paying us to sell you their BS products, right? We just kind of tell it like it is and maintain fiduciary sensibility. And so lately we think, you know, even in terms of behavior, lean into that where we can. So, okay, if I'm in the shoes of an RIA, I'm getting hounded by my client of a long time who's interested in the IPO calendar, and they have their picks. And so I've got to tell them, you know, well, I guess, you know, oh man, if I invested in Amazon 20 years ago, if we invested in Facebook when it crashed after the IPO, it was fine. We don't care if it crashes after the IPO. Look at what happened to Facebook. And so those, you know, winner take all stories, like in hindsight, everybody's smart, right? So, but it took a decade or two for those stories to develop. And so, you know, what's in the best interest of the client? Well, definitely it's not avoiding the IPOs, right? Because those are growth engines for their portfolio, for their retirement, especially for the young people. Like that, you want to have a certain amount of risk to reach their goals. So what is the right modus operandi to deal with the stuff, right? Well, if you look at back in the 2000s, right, now it's just so easy. It takes 5 brain cells to know what the big categories were. Online retail was a category. Search, social media, could probably come up with a couple others in terms of hardware, or, you know, the backbone of the internet infrastructure, yada yada. So come to present day, you know, you can start to articulate those. Not too much harder. They're not so ingrained in our psyche that we can just rattle them off cuff. But it's transportation. You know, whether that's Uber or Lyft or some maybe GM involved in auto driving, maybe it's Tesla. Who knows? But it's transportation really. You know, that serious paradigm shift to auto driving, electric vehicles, whatever that is. That's a category. Shared economy stuff, you know, maybe part of that is hospitality, though that's completely being redefined. Whether it's Airbnb or, you know, the different travel companies that have bought up Airbnb competitors, find that out and then, you know, spread your bet between that shared economy stuff. Point of sale, everything from Shopify to Clover to Square. To Visa and kind of the big stalwarts themselves, right? Coming into that point of sale area, that cashier is kind of history, right? The cashier as we knew it. Not only If the transportation is about the driver as we knew it, as we knew them being history, well, then the cashier is the second job. You know, more of those folks on the planet than anything else, on any other job probably. And it's very much in shifting mode. So what's going to win? You don't have to know, but just know the fact that that category is what's shifting, right? That is underlying so much of what Hidden Levers is about. You know, spot the macro trend, right, and be part of that wave. And so recognizing the category, not too hard, and then buying a basket instead of trying to pick one winner, right? That could be through a fund that's doing that. That could be, I know Motif has gotten quite good at picking out certain companies that have a macro theme, and they're going for an advisor audience. There's different ways to do it now. Even Orion and other software tools, they're trying to do index replications where it has nothing to do with an asset manager. They're buying the underlyings, and so but it's based on certain rules or kind of concepts that the tech company can handle much faster and more efficiently than the asset managers. So that's an option. In any case, that winner take all story will be a recurring story. It just takes a long time to play out, right? Facebook, I think, after its debut, Praveen, it started at 45 and went down to under 20. It broke the $20 barrier, so lost more than half its value. And well, it's been a come up story yet again this past 6 months. But all these categories from the 2000s that are so ingrained, you got to figure 10 to 20 years from now, the ones on the right, along with half a dozen others, those will be huge categories, and the winner will be kind of identified. So, as that plays out, they're called pair trades or mutual, finding the right funds or maybe private investments that deal with that.
Absolutely. And and so making those, selecting those baskets, or just making sure that you're appropriately exposed to the tech and IPO story without getting a client overexposed, because maybe you picked Twitter instead of Facebook, or if you get it wrong, then you're not going to participate in the returns, because the returns go to the winner that takes it all, and that's usually just one name in a category. And so that's the challenge. All right, well, let's move now to talk about the market highs in context and sort of where we are. Obviously, we've seen now a couple of days with a little bit of a pause in the market ripping upward, but we are back here above October, or right around October in last January. And so, Raj, what do we really see here? I mean, it seems like on the one hand, maybe not that much has changed, from this macro look from January to today.
Yeah, I would say the biggest change in my book is, if you remember Back to the Future Part 3, the last one, where they had that locomotive train, and they toss in the 3 turbo boost logs, futuristic logs into a wood-burning locomotive engine. So what are those 3 logs for these highs to not stay here? What got us back was an upside surprise in GDP, both in China and the US. So those are 2 logs right there, 2 biggest economies in the world. I think China's back on steroids and with their stimulus. But America, the strong underpinnings here of the economy are much more dominant than anything that we've talked about with IPOs. So it's quite important. 400 billion, I think, is the total value of the IPO calendar, and I mean, that's just nothing compared to the surprise GDP print from America. So, but besides that, the other one, the one that really screams more than anything to me, is the Fed's stance. In January 2018, the Fed was hawkish as anything. And the new tax plan had taken hold, and we were kind of still very much in the raised rates regularly and get out of this new normal low rates environment thing. Just forget it. Get back to where we were. And so that's shifted a lot. You have a lot more dovishness now, and we did a war room on that last month called Fed's Dead, so you can check that out if you'd like to see more on the Fed's 180. Besides that, yeah, it's pretty much the same numbers. Maybe those rates are a little bit lower, GDP's higher, but other than that, it's not that different.
Right. It's very much a story where that, and I think you put hit the nail on the head really with calling out the change in Fed stance. Well, another aspect of that, of course, is that a year ago, or a little over a year ago, January of 18, rates were a lot lower than they are now. So, all those rate hikes later, the Fed has switched to a dovish stance, and that sort of enabled the Q4 or the bounce back from Q4. It's sort of amazing. We talk about it internally here, the extent to which the market is sort of keying off of the words of the Federal Reserve and how important that is. And certainly we just visited it, like you were saying, Raj, recently in the war room, and the idea that the Fed seems almost impotent now to do anything other than what the market asks, because the market throws a tantrum, and then they feel powerless to do anything but comply. And at any rate, that seems to be the environment that we're in. If you think that environment can't persist, then I would refer you to the Bank of Japan, where they long ago gave up on the pretense of not wanting to interfere with equity markets, and they just started directly buying Japanese ETFs and Japanese stocks. So they gave up on any pretense at all. And the Bank of Japan is now one of the larger holders of Japanese equities. They argued that, hey, this is a novel way for us to fight deflation at the time. But once you get started on that drug, it remains to be seen whether or how central banks can roll back policy changes like that once they make them. And so, because of course, if the central bank starts selling Japanese equities, what's that going to do to Japanese equity markets? So it's a difficult one-way street. And we've seen similarly that the Fed in the U.S. has had trouble going all the way with shrinking its balance sheet. We made a few moves in that direction, but have talked about slowing that substantially as well. At any rate,
I'm still optimistic that within the Fed's dead scenario, the positive outcome was this is a momentary pause. I'm still optimistic that the hawkishness can resurrect itself. Here's what I see that's kind of funny on that chart, right? You got lower rates today. You got lower rates today, but because of that GDP print, what's underneath that is more money coming through to America and a stronger dollar, even with lower rates, right?
Right.
That might say more about Europe, honestly.
Yeah, it does say something about Europe and Europe's weakness and global rates for sure as well.
And this month, as the economic research team got together and said, okay, what's it going to be this month? It was a big toss-up between whether it's going to be new highs or it's going to be something about the IPO calendar, and definitely not just because of Notre Dame burning, but definitely the symbolism of that of that and the economy there, kind of negative rates in Germany, all those things go together of Europe being just in dismay, and so we thought, is it time to cover that? It's sad, but that it says more about Europe than the strength of the American dollar, or to say that, right? We have lower rates and our dollar's stronger, and we're more dovish, and the money's still flowing into dollars. So, in terms of
you can see it in euro, and you can see it in the value of the euro and the pound as well. Even though our rates are lower. So
it's complete dysfunction over in Europe, which we'll probably cover maybe into Memorial Day, I guess, but it's a secondary topic compared to what's going on here. So I just want to point that out. All right, let's talk about the market highs and kind of good comparative tools for where we are right now. We've covered where we were in 2018 at the cusp of 2017, 2018 on the highs there. Very much the same in terms of some of the leading indicators. Now let's compare it to what everybody really wants to hear about, which is this like the dot-com crash? Is this going to be like the dot-com crash?
Right. And one interesting thing about this is that, so this chart, of course, is pretty straightforward, but number of IPOs in blue and then dollar volume there in that green, in billions. And so, of course, we can see the big years of 99 and 2000, the big years in the dot-com era, dwarfing all but the plans for 2019. Perhaps it's a bit disingenuous, only in that 2019 isn't actually in the books yet, and so we don't know if all of these IPOs are going to happen. But it's really worth noting this first point, which is that Uber's IPO value alone, say they go out at 100 billion, then it's roughly equivalent to those banner years in the late 90s. I do want to note that this is not inflation adjusted, but for the purposes of some calculations we're going to show you in a moment, we did inflation adjust it. And even if you inflation adjust these numbers, they're at most like 150 billion. So 150 and change versus Uber at 120 for one IPO to be worth the same as 445 IPOs. So those, remember, the blue is the number of IPOs. So for one IPO to be worth basically the, hundreds and hundreds of companies worth, that is pretty mind-blowing, and partly that's because of this middle point, which is that companies are staying private longer. Private equity has, the amount of capital available in the private equity space has really exploded, between 1999 and today, and so you see a lot more private investment and a lot more companies staying private. In fact, some of these private companies have substantial investments from public mutual funds. So in essence, they're already getting participation from and retail investors just through mutual fund vehicles, and and so that money has flowed in to them. So that's one reason why these companies are a lot bigger. But even when you take that into account, the idea of there being potentially 400 billion, we also, to be honest, we saw wide dispersion in the numbers. 400 billion is the number that we went with for this year. We've seen it as high as 700 billion, but that seems so comical, but just to give you a perception that it could be 4x in valuation terms versus 99, but even if you inflation adjust it, once you account for the whole calendar, it's still many, many, many times, even though the sheer number of IPOs is much smaller. So these are just bigger companies that are going public. But as we saw in earlier slides, just because they're bigger doesn't mean that they are more mature and more profitable. No, they're not. These companies, 90 or not quite 90, 85% of them are not profitable. And so they are very large, but not mature. Where I'm defining mature in terms of profitability, because in many cases, if you take Uber and Lyft, and I'm sure that their CFOs and their C-level team would argue with us all day long when we say that they don't have their unit economics figured out. But if you do the math on a single Uber ride, it doesn't really add up. And so getting to profitability for them and getting to sustainable profitability might in fact involve driverless cars. And so that's just an example of the degree of maturity of the company. They have to, potentially to really hit the numbers out of the park and be worth that number, the 100 billion plus, and then to grow like the other MAGA, tech giants that we talked about, to grow 5 or 10x from there. They have to invent a technology, because self-driving cars, whatever you may have heard, don't actually work, reliably enough to be totally on the streets. So they have to finish completion of that technology to get their business to be mature enough. That sounds more like a startup than it does like a mature $100 billion company. And so it's a different set of risks, and it's sort of a different place in their life cycle when they're coming to.
If you think about where Netflix was, right? Netflix is a company that sent you DVDs in the mail. Isn't anything close? It wouldn't be, if it was still that company, it wouldn't even be close to the streaming media.
Absolutely.
Company. And then even maker of its own content, right? So like that's Netflix is in a different place. So the bets on these things, I feel like with Uber especially, it's almost pricing in that next level success now.
Yeah, absolutely. I mean, you're pretty much anticipating the world is going to change. You're betting on which horse you think is going to, well, I don't know if horse is the right analogy, but which company is able to transform, to meet the future, wherever that ends up being. Well, I wanted to take a look at another look at the same chart, but here we thought, well, this is an interesting chart, and anecdotally, it seems like the big waves of IPOs, like the late 90s, seem to be followed by potentially negative numbers, negative market years. And so we thought, well, let's try and at least do a simple analysis of this based on the data that we have. So what we found was, if you look at just the raw correlation between the IPOs and S&P returns, then you don't find anything particularly interesting. But when you shift it, so you shift a year forward. So here, the returns that we're showing on this lower strip of numbers are a year later. So with 1997, this is 1998 S&P index return, price return. We didn't do total return for these purposes, but it gives you the idea. And so for each year, that is the next year's return. Therefore, for 2018, we don't actually know what 2019's return is going to be. We just pencil in 15 question marks, since that's roughly where we are today. But and of course, for 2019, we won't know for another year. At any rate, when you look at this and you look at these clumps of red, so you've got the clump of red around the IPO deluge of the end of the dot-com bubble, but then even this small peak, where there was sort of a local peak in the number of IPOs, the dollar value of IPOs in 2007. So that's obviously 2008's return there. And then even 2014, so 5 years after the crash, companies are trying to get out the door again. And 2015's returns all of a sudden are quite poor. So that doesn't necessarily fit the narrative. Nobody talks about how 2014 was a big IPO year, but in fact, it fits when we line these numbers up. And then 2017, after falling, IPOs started to recover. And again, 2018, last year's returns, as we know, weren't that great. So interesting trend there. It turns out that the correlation in the numbers is statistically significant and negative. It's negative 0.37 when you compare IPO volume and the following year's S&P 500 returns. So we thought that was of interest. Well, if there is that negative correlation, something to keep in mind as we look at the fact that this year might be shaping up to be a banner year. Does that mean that 2020 is when the other shoe drops? And if we think about this, though, okay, so that that's an analysis of this sample, this data set. I'll be the first to admit that, of course, this is a limited data set. We'd like to run it backward further and look at it in more detail. It is small, but it does fit with, with an idea that makes sense, which is the idea that if you were an entrepreneur and you had a company that was going to go public, wouldn't you want to IPO at the top of the market? Because think about what an IPO means. That's when you personally get to sell some of your shares to the market, so that liquidity event, and not just you, but the shares that the company itself is issuing new shares to actually raise capital. You want to do that at the top of the market because that's when you're going to get the best value for your IPO sale. So that's money in the bank. If the next year starts a recession or the next year things start to go downward, at least you put money. Yeah, you put that cushion in your bank. And so it absolutely makes sense that individual CFOs and CEOs of these companies should be trying to time when a market top or when things look really good.
Real estate mogul trying to sell there at the top of a real estate market. There were definitely plenty of smart people trying to sell their homes in 2007. So here it's shares in their equity in their company.
Right. And even if individually none of these people can actually predict the market, they certainly have a sense for, the market feels good now or it doesn't in terms of the conversations I'm having and what the bankers on the street are telling me about whether or not my IPO is likely to be successful right now. When can we get on the calendar? All those conversations sort of lead naturally to everybody trying to rush out the door at the same time. One last point I'll make on why this correlation might be real and why it's worth paying attention to is the fact that when new companies come into the market, what does that do? Well, it increases the supply. Like if we just think about basic, supply and demand, all things being equal, it increases the supply of shares available for equity market investors. And so that has to be taken up. The demand has to be there to buy those shares. If folks really aren't that feeling that great about equities in that next year, well, then maybe they're selling other equities to get into these equities. And so, there can be that increase in supply, with fixed demand does what? It lowers price. That's economics 101.
I feel like the market pundits are talking out of both sides of their mouth with that one, right? They say that there's a fixed amount of money, and so the attention span and the dollars, institutional dollars going into IPOs have to come out of somewhere, they say. On the other side of that, you got the BlackRock CEO as well as others chiming in that there's a record amount of money sitting on the sidelines. So how are
Right.
both true, right?
Yeah. So which is it? Absolutely. So which is it?
Word that's been used actually.
Yeah. Well, and so continuing on that theme, because so maybe the previous slide or that thought process gives us pause. So, but let's look at the other side of the coin in terms of, for context, where are we in the economy right now? And this top left chart, I think, really calls out what is the strength story, the story that, you hear sometimes, but it really hasn't been reported on so widely. It's this idea, and a lot of economists are still skeptical of this, and we don't know for sure if it's going to happen or not, but that 2% was sort of the so-called new normal, GDP trend. If we look, so post-recession, so post-2009 into 2010, we got over that 2% number, and then we just sort of oscillated around it. So that average GDP growth all through those, the teens up until last year were averaging around 2%. And, then we started to shift upward. Perhaps that's impacts of the tax cut, of some of the stimulus, because there was an increased spending as well, government spending, and maybe that's just, naturally getting to the top of an economic cycle. Whatever those specific factors are and adding up, it seems like we're finally potentially starting to break trend here and get over 3%. And, we'll know over the next couple of quarters if this is real or not, to get over 3% and stay over 3%. So that's, we label that in green because that's a strong positive indicator. Second one, the yield curve, of course, frightened everyone quite a bit earlier this year. But we wanted to note that because of the Fed's actions to sort of pause and to become more dovish, that actually put a halt to the shrinking of the spreads, like the 210 spread, for instance, is what we're showing here. But so it was the 3-month 10-year spread that temporarily, that inverted for a very, very short period of time. The 210 spread has not, and it's sort of staying stable right now and actually trending upward. So if that is a reason for fear, at least that has not really, it hasn't hit ground just yet. Now, if those are the two positives, the two negatives that I would note, first, up here at the top right, let's talk about home prices for just a moment. So we see a super oscillating picture here. So what is this? This is monthly percent change in home prices. Many of you know, perhaps even just from a common sense wisdom standpoint, that home selling is extremely seasonal. Well, we see it here. I think what this chart is saying is don't sell your home in the winter. But if you're selling in, the spring, every year prices go up a little bit and they come down a little bit, or the rate of growth goes up a little bit, then it falls down. For all of the last several years, even in the winter, the rate of growth didn't really go below 0 at any point. And then this past winter, for the first time, we saw that it did. So there's kind of a question now about, are we finally starting to see the U.S. home market start to slow down for real a little bit? And if so, what does that mean? And then finally, just looking at the job market, while the job market is extremely strong today, and of course that on the surface would seem to be a good thing, I was just noting here that in both 2000 and in 2008, we basically had hit the lows on unemployment figures, and we were oscillating around the bottom. And that was where the market top was, when we were bouncing along, skittering along the bottom. And it seems like, looking at this chart, that maybe we're oscillating and skittering along the bottom of, with unemployment being in the high threes, just below 4%. So those are kind of the two warning signs. Now, to me, the top left, GDP is by far the most important. If we show another GDP, print going into the summer where we're consistently above 3%, well, that's the most important indicator of all. And, then that means things really are going strong. And maybe the economy is hitting escape velocity. If not, well, then some of these other warning signs, maybe, in addition to the IPO warning sign, maybe worth heeding a little more closely.
The one thing we can say, though, this comes also from technical analysis, is the biggest moves come at the end of moves, right? And so the top in both, whether it was early 2000, I think, or late 2007, whenever that is, the biggest moves come at the end of moves. And so expect a blow off top when it does come. You know, kind of sometimes bordering on irrationality. You can see some of the tech stocks behaving that way, starting to behave that way finally here. You know, we're getting up and down. For Google's 10% hit, which we discussed today, you can see Apple's upside, right, completely rocketing back above 200 now, and as well as some of the other smaller tech companies, let's say the Square or Spotify, not Spotify, was Shopify, you know, like double-digit percentage moves on a daily basis. So those that credo has definitely helped me over the years, you know, both on the downside and the upside. Ludicrous moves toward the upside are are also increasing volatility the same way they do big downside moves. Have we seen volatility increase at all, Praveen? I don't think so. I mean, it's
no. You know, actually, I was looking. We were looking at that. Well, what we saw, I suppose, if we go back a couple of slides to, you know, we see here that volatility is slightly higher than it was in January of last year. Volatility was sort of at record lows in the period prior to 2018, but it rose a bit, and certainly during the choppy period late last year, and then even February, in that time frame, we got some volatile patches, and so the VIX stayed in the teens through the middle of the year. But it's pretty much settled back down now. Now we're back down to a VIX of 13. So no, we're not really seeing any excess volatility. And the trouble with volatility, when you look at charts of it, is that it really seems to be very much, it's of course tied to market movements and somewhat inverted to the S&P itself, but it doesn't seem to necessarily be predictive of anything. So it's really hard to use in that sense.
Okay, well, let's get to the scenario, Praveen. Thanks for that. You know, we do have a tech bubble scenario on site, and we thought, well, should we update the tech bubble scenario? We just did that in December, and a lot of those pieces hold, right? The baseline bad scenario, bull market correction. As we can tell, that's exactly what happened. Usually, if things are happening the way they're most predictable, it'll be in the yellow area, right? That's what is a continuation of that trend. We're articulating that trend, and then the endpoint's something on the upside and the downside, right? And explaining all three, with the kind of bad or baseline scenario being right in the middle. That's a very good fiduciary, MO, like in terms of talking about economics. Not too married to one outcome, but identifying the bookends of the boundaries of how it could go. Not alarming somebody just by talking about the downside. In any case, the tech bubble was there, and we still talked about upside, but it didn't really capture these IPO risks, right? We wanted to be specific about that, whether it's Airbnb, Lyft, and Uber, the ones you know about, Palantir, big data company, who kind of, they're a big data analytics company like us. Pinterest and Casper, the mattress company. These are becoming household names pretty fast, right? Slack, which probably a lot of you use. We definitely use it around our office. And WeWork, you see those popping up in every hipster neighborhood, and now the boring neighborhoods in every city. And so these are somewhat getting to be household names. And we thought, well, we don't really have a way to capture their impact on the market, especially as GDP is dominating, and it may be breaking out. These IPOs are happening too. How do we capture that? Does it deserve its own scenario? And we've decided yes. And so here it is. In terms of the baseline concept, it's, this strong GDP is very dominant story, and whatever IPOs dysfunction there may be, whether they're profitable, not so profitable, all that, all boats lift with the strong GDP. And so it may not be about the IPO fundamentals themselves. It may
I'll do a live edit here, Raj, because it's 4% actually on the upside. So this is really the idea of getting back to, that 90s era. But yeah, you're absolutely right. That strong GDP lifts everybody.
Yeah, and so that's our baseline. We are one to question the GDP numbers. They're not. Maybe they're politicized. Maybe they're not. But we can feel it around in terms of hiring between Atlanta, Los Angeles, New York. We're seeing that kind of hiring. Where does that leave, besides the that strong GDP where we are now? it kind of affects the S&P and NASDAQ in the same way. Not too much of a breakout for NASDAQ based on these IPOs at the current pace. That's another big distinction from the 99 run up, right? Here any strength or weakness in the IPOs is pretty much shared now between the S&P and NASDAQ. As for the upside scenario, what could really happen? Well, these tech leaders, if they're in the right position, you got huge job creating machines, productivity machines, those same tech IPOs that lead to substantial rising wages, consumption from the employees. Consumption was the weak link that we said in the GDP numbers. Although it was strong, the weaker link, the weakest of that strength, was something that America is really good at, which is consumption. So that was surprising. But getting back to having these new tech companies, these really be a boost for the GDP, it would have to be because it starts affecting consumptions. And I'm not talking about the fetishized stories of the San Francisco millionaire set, increasing by the thousands. I keep seeing those stories, and it makes me dread going to San Francisco. But that's not the real point. The real point is the daily consumption by those people, that marginal propensity to consume, the wealth effect, etc., as opposed to just buying top 1% type stuff. So that really is where the upside scenario comes from, and the growth in the economy, as we pointed out in this session, has been tech led. So it's continuing that, adding to different nuances of our lives with tech that become such a staple. So I guess in a nutshell, the really good scenario is if the tech IPOs of today, those become tech staples of tomorrow. On the downside, the ugly scenario, you're looking at about a 1/3 correction in NASDAQ, and that's if these you see definitely bell ringers of the alarm bell talking about these IPO fails is one of the biggest risks to the market right now. And so that's why we wanted to take a look. That correction isn't to us the .com crash. That's nuts. If you've not taken away anything from this session, that there is no .com crash coming, right? If there is a correction, it'll be something that rhymes with the end of 2018. There was definitely panic, but that was nothing close to a .com crash. I think that was a 50% haircut on the NASDAQ, whereas I think we barely touched 20%, which is a bull market correction all the time. Happens all the time.
Absolutely. Well, and you had more, to your point, you were mentioning earlier about how the NASDAQ and S&P separated a lot more in 99. And so the NASDAQ from its top to its absolute bottom over the course of like almost 3 years is almost 80%, which, would be unthinkable now because the NASDAQ has those tech stalwarts, the MAGA companies as we called them, that would underpin it, from that being a realistic version of a downside scenario. So instead, something much more like just a more pronounced version of Q4, a little more, more severe than that, but not the 80% downside or 50% downside that the S&P almost experienced. That seems to be.
And that's where you all as advisors, you can really own the show, right? Where you have a scared or panicked client worried, maybe they lived through that .com crash. And as we've talked about with the financial crisis, there's certain PTSD that goes with that. And so for you to talk about the macro in this deliberate way, right, avoiding random fear mongering from the press and just contrasting the .com crash and talking about how last year felt like that because everybody was so spoiled because of the melt up over the past 5 years. Just explaining the difference between those two will be so reassuring for clients. And if they are looking for a new advisor, then it'll help you win business or take wallet share, whatever your purpose is.